Hello and welcome back to Chapter 11, Responsibility Centers. This is your second and third learning objectives. We are going to be looking at responsibility centers, that is cost centers, profit centers, and investment centers, as well as the return on investment. So what is a responsibility center? Well, it is broadly defined as any part of an organization whose manager has control over and is accountable for cost, profit, or investment. Thus, the three primary types of responsibility centers are cost centers, profit centers, investment centers. Organizations categorize responsibility centers into one of these three types based on the manager's authority to control cost, revenue, and investment funds. So a cost center is a segment whose manager has control over costs, but not over revenues or investment funds. A profit center is a segment whose manager has control over both costs and revenues, but no control over investment funds. An investment center is a segment whose manager has control over costs, revenues, and investments in operating assets. So this is important when talking about performance measures, which we'll do more robustly in our next video. However, looking at one formula that tends to be used for managers is a return on investment, and that would be most applicable to our investment center managers. Let's look at how we calculate that return on investment. So our return on investment, our ROI, is equal to our operating income divided by our average operating assets. So it's average. If you're looking at financial statements, you would add up the cash, accounts receivable, inventory, plant and equipment, and other productive assets for 1 year, and then the other year, and divide by 2. And that would give you the average operating assets. However, if you're only given one set of numbers, then you would be given, you would use the set of numbers that you have for that year and call it the average. Otherwise, you would want to take the average, which would be the 2 years, divided by 2 to get this average operating assets. So specifically, when looking at EBIT, so our operating income, this is equal to our income before, so our EBIT stands for earnings. So our earnings or income before interest and taxes, our EBIT. Operating assets are going to be, as we discussed, with our cash, AR, inventory, plant and equipment, and all other assets that are meant to be used for productive use in the organization. There have been arguments for using net book value or NBV to measure the operating assets in the ROI calculation. And that's because it's consistent with how plants and equipment are reported on the balance sheet, and it's consistent with the calculation of operating income, which also includes depreciation as an operating expense. However, conversely, arguments for using the gross cost, so that is the total cost of the asset, not net of depreciation, to measure operating assets for ROI calculations includes it will eliminate both the age of the equipment and the method of depreciation as factors in the ROI, so less to be manipulated, and it does not discourage replacement of old worn out equipment. So for example, if you used the net book value method, so the other method, and it was a fully depreciated item, then your assets would be really small and your ROI would look really big. And then if you replaced them, then your denominator would get bigger and your ROI would go down. So if you use the gross method, then it wouldn't really matter because if you would just make the best decision for the company, you would replace them because that's what you need to do. You need to eventually replace old equipment. So both have their pros and cons. A visualization, so of net book value versus gross costs. So as I said, most companies would use the net book value being the Cost of the asset less accumulated depreciation gives us a net book value. But if you were to use the gross cost, that would be the $3 million here. Just what did you pay for it? What is it landed? What did it cost us? There are 3 ways to increase return on investment. We can increase sales, we can reduce operating expenses, or we can reduce operating assets. Let's look at a comprehensive example together. Regal Company reported the following: operating income of $30,000, operating assets of $200,000, sales of $500,000, and operating expenses of $470,000. What is Regal Company's return on investments? Now, I also need to point out that ROI, as we saw, equals operating income divided by operating assets. But if you pull those apart, and add on sales to the bottom of operating income and sales to the top of average operating assets, this is the same formula. This is still our ROI, because if you were to cancel out sales, and smush these together, we're left with ROI equals operating income divided by average operating assets. However, the reason why we're looking at this is because ROI can also look like margin times turnover, because margin is equal to operating income divided by sales, and turnover is equal to the amount of sales that we had divided by the average operating assets. So 2 different ways that we can present ROI is margin times turnover, or operating income divided by average operating assets. Something to keep in mind as we go through these next examples and as we go through to our quick check and the rest of the material. All right, so let's calculate Regal Company's ROI, and to do that, let's go to some Excel. All right, so what is Regal Company's ROI? Why is my laptop? Why aren't you typing? There we go. ROI. Okay. No, stop typing. ROI equals, let's do operating income divided by average operating assets. We're given both, so might as well use these. So ROI is equal to operating income. It's equal to 30,000 divided by average operating assets. Nice that they gave it to us. Be prepared. You will also need to calculate it. And our average ROI is equal to 0.15. That is also typically presented as a percentage. So in order to get a percentage from a decimal, we times it by 100, and that gives us 15%. You can also just click here and hit the percentage button where we have, and see 15%, and then move our decimals over. Okay, 15%. All right, so let us continue down with the next slide. And you'll see we have a few. So now let's see, how are we increasing sales without an increase in operating assets? So how do we get sales up without having an increase in operating assets? Well, Regal's manager was able to increase these sales to $600,000 while keeping operating expenses at $558,000. So their operating income increased to $42,000. There was no change in the average operating assets of the segment. So let us calculate that new ROI. All right, so we have operating income, ROI, and that is equal to, we can use either calculation because we have all the information. I'm going to go to the quickest one, as you should in the exam. And so that is going to be our operating income divided by our average assets as above. And so we have our operating income, and that is going to be the $42,000 because it got increased to $42,000 divided by no change in average operating assets. Okay, so above that was $200,000. It will still be $200,000. And so great, cool. Thank you so much for increasing this from 15% to 21%. All right. Great. All right, let us continue on with looking at what happens when there's a decrease in operating expenses with no change in sales or operating assets. Okay, so we now assume that Regal's manager was able to reduce operating expenses by $10,000 without affecting sales or operating assets, and this increased operating income to $40,000. Interesting. I wonder what did they do to reduce operating expenses by 10,000 and then increasing operating income to 40,000, right? Because you'd kind of expect if you cut operating expenses by 10,000, sure, operating income would be increased by 10,000, but you typically do not cut costs and then have your net income increase. But maybe they found some really good process efficiencies and they were able to maintain strong sales. So could happen. Let's calculate the new ROI. Let's have at her. Great. So I'm going to use the same formula. I don't need to expand at all because my ROI inputs are here. So my ROI is going to equal my operating income, which is going to be 40,000 equals 40,000 divided by, and I didn't affect any of my sales or operating assets. So great, my operating assets up here were 200 and they are still 200 as I can see right here. Cool, 40. And pardon me, I probably had an extra zero in there. Nope, I was missing a zero. And these are going to be 20%. All right, so not as high as what we did here, but higher than our 15% that we started off with. Alrighty, let's look at one other assumption. Assume that Regal's manager invested in a $30,000 piece of equipment, something big, something shiny, something amazing, and this increased sales by 35,000. But it also increased operating expenses by 15,000. What is the new ROI? Here are our inputs. So we have use our same formula. And we're going to have our ROI is equal to our operating income $50,000 divided by our average operating assets, which is going to be 230. And now, all right. We then went from 15% to 21.7%. So perhaps you had a question on your exam, maybe it's the final exam, where you were given this situation and you were given these 3 scenarios, very possible, where you can either have an increase to, anyways, you're given 3 scenarios and you were like, hey, which one should the company pursue? So then you would calculate each one of these and you would go with the highest one. So right now, scenario number 3 looks like the winner because it is higher. Now, maybe there's some qualitative factors to consider, some things that maybe we'll touch on in the next video, the balanced scorecard, like perhaps this includes something bad, like potential environmental dumping or, something very, very bad. Those are qualitative factors, would definitely deter you from taking on something, even if it's more profitable. So definitely do have some qualitative decisions, considerations to make. However, based on purely the quantitative analysis, if you're going from 15 to one of these 3, you would pick scenario number 3 because it's higher. All right, let's go back to the slides. ROI has its advantages, absolutely, but it definitely has its criticisms. Managers will often inherit committed costs in which they have no control over. So if you have no control over something, it gets pretty frustrated when you are evaluated on it. If they don't have really much input into things, the management might not know how to increase the ROI. So again, it could be pretty frustrating. And managers evaluated on ROI may reject profitable investment opportunities. Maybe they are uncertain about how it'll play out. They're less likely to take risks. And, with that, they're possibly less likely to earn those extra revenues. So really just depends. Have to kind of, as you'll see in the next video when we talk about balanced scorecard, that's why Financial and non-financial performance measures can really help with executing the company's long-term strategy, whereas ROI does tend to be focused on the shorter term in 1 year. And even within that shorter term, sometimes managers don't have a lot of control over things. So definitely not without its criticisms. All right, let's look at a quick check to finish us off strong. Hey, Redmond Awnings is a division of Wrap-Up Corp, and they have an operating income of $60,000 and an average operating assets of $300,000. The required rate of return for the company is $15,000. What is the division's ROI? So please pause the video and come back, and we'll see you soon. All right, welcome back. I was on the fence as to whether or not we use Excel for this. You'll know what I mean in just a second. But here we go. All right, ROI equals, and we would take our operating income of our 60,000, 1, 2, 3, divided by our average operating assets of 300,000. And if you picked 20% D overall, you would be correct. So D is your correct answer, as you will see in the slides. People, thank you so much for your time and attention. Keep up the great work, and I will see you in the next video.